Assalamualaikum everyone. We are from the last group. We'll present to you about the application of derivative in conventional and Islamic banks in Malaysia. Before we start discussion about the topic, I would like to introduce my team members first. Okay, like usual, we have myself, Fatiha, we have Sarah, we have Shima, Lingesh, Amar Azlan, and lastly, Renal. So without wasting any time, I'll be moving on to the introduction part. Okay, firstly, the globalization of the economy has caused businesses to become more mindful of financial risk throughout the last 30 years. As a result, the financial service sector has come up with some amazing products to mitigate this risk, which is derivative instrument. But what exactly is a derivative? Is a contract which value is derived from the value of something else, most often cash investment like stocks, shares, money instrument, or commodities. So experts, they have argued extensively about the importance of derivative from both conventional and Islamic perspective. The performance of market instrument in derivative market is influenced by the performance of other instrument. The contracting party have the option of exchanging physical counter values if the market is regulated properly. So derivatives transaction can take place on either a regulated or unregulated market. In other words, contracting parties can enter into a derivative transaction based on market performance without using any contractual instrument or any underlying assets. So this is because derivatives are financial products that rely on the performance of other instruments to be traded into the market. The type of derivative in conventional bank. Derivatives are financial instruments which value is calculated by the underlying asset. So as a result, the underlying asset decides the price, and if the asset price increases, so does the derivative price. So as you guys can see here, futures contract, forward contract, option contract, and swaps contract are some examples of derivative in conventional bank. So the aim of such security is to provide marketers or manufacturer with a way to mitigate risk. Moving on. Okay, so I will explain more in detail about all these contract. So firstly, futures contract. Futures contract are agreement between contracting parties to buy or sell a specific financial instrument agreed upon in the future at a fixed price and at a specific period, which is called expiration date. So futures are exchange traded contract that decide a commodity size, the delivery time, and the price. Since futures are standardized by an exchange, they can be exchanged effectively. So a futures contract specifies various characteristics for each commodity traded. And the first criterion is the commodity's consistency. The product must meet certain criteria in order to be traded or on the exchange. So, and the scale of a single contract is the second factor to consider. The size of a commodity decides how many units are exchanged per contract. The delivery date, which specify when or in which month the commodity must be shipped, is the third factor to be considered. So next, the swap contract. Okay, a swap is a derivative in which two parties agree to swap one source of cash flow for another stream of cash flow. For example, a company paying a variable rate of interest may swap its interest payment with another company that will then pay the first company a fixed rate. So swaps can also be used to mitigate interest rate risk or bet on market increases. When exchanging goods, for example, the first party, a fuel airline, agrees to pay a fixed price for a predetermined quantity of the commodity. The other group, which is the bank, agrees to purchase the product at the spot price. So the airline business is guaranteed at the price for its commodity as a result of this arrangement. In this situation, the bank will bear the cost of an increase in the commodity's price. Moving on to the next slide. So for forward contract, the forward contract has been recorded as the first derivative instrument to be used, and it is also the simplest in form. In a forward contract, two parties undertake to complete a transaction at a future date, but at a price which is determined today. So a good example would be a farmer who anticipate his crop, the maize, to be harvested in the near future, and a consumer who is in need of the maize in the near future as well. So both parties they are faced with the possible risk that the price of the maize may decrease or increase respectively. So therefore, to hedge their risk, they enter into a forward contract to lock in the price of the maize to be paid and delivered in the future. So at this point, there is no exchange of money or commodity. That's an example. So a forward contract is an arrangement to buy or sell an asset at a fixed price on a fixed asset, fixed dates. There are two positions for this contract, which is long and short position. A long position is taken by a party who agrees to purchase the underlying asset in the future, while a short position is taken by a party who agrees to sell it in the future. So the delivery price is equivalent to the forward price at the time the contract is signed. And lastly, option contract. Okay, an option contract allows one party the ability to buy or sell the underlying asset at a predetermined price at a future date. On the other hand, the other party is obligated to sell or purchase the underlying asset at the agreed upon price. Okay, so there are call and put option. The call option give you the option to purchase, while the put option give you the option to sell. So in more detail, a call option give the buyer the right, but not the obligation to buy the underlying security. It gives a buyer the right to buy an asset at a predetermined price for a certain period of time. Before the sale contract is completed, the buyer pays the seller a premium. This is the amount of the option. So the purchaser does not have the right of option if the premium is not paid, since it is not included in the price of the sold item when the party signs the contract. Meanwhile, a put option is a seller's right to sell an asset at a predetermined price for a specified length of time as negotiated by the contracting parties. So when the asset price exceeds the price, a put option is said to be out of money. In this situation, the put option will be not executed. If the asset price is less than the price, the put option is said to be in the money. So in this situation, it is preferable for the seller to execute the option contract before the option date expired. Okay, moving on to the derivative trading in Malaysia. One of it is commodity derivative. Commodity derivatives are the commodity futures and commodity swaps that use the price and volatility of price in underlying as the base to change in prices of the derivative, so as to amplify or to invert the way in which an investor can use them to act on the underlying commodities. So for example, crude palm oil futures, FCPO. FCPO is a ringgit Malaysia denominated crude palm oil futures contract traded on Bursa Malaysia Derivative, providing market participant a global price benchmark for the crude palm oil market since October 1980. So what is this FCPO? FCPO is a derivative contract between a buyer and a seller to take and make delivery respectively of crude palm oil at a future date. So it is a physically settled contract, which means that upon expiry of the contract, the buyer and the seller would have to take and make delivery respectively of the physical crude palm oil. So for over the last 30 years, this FCPO is actively used by edible oils and fats industry players as a risk management solution, as well as by fund managers and financial institutions for managing price fluctuation in the market. So next, what is the deliverable unit of CPO? The delivery unit of CPO per FCPO contract is 25 metric tons, not more than 2%. So this means that the weight of the delivered CPO must not exceed or be less than 2% of the 25 metric tons per contract delivered. So the settlement of weight differences, it shall be based on the simple average of the daily settlement price of the delivery month. And lastly, when is the delivery period? So the delivery period is from the first business day to the 20th day of the spot or delivery month, or on the preceding business day if the 20th day is a non-business day. So the day of delivery of the CPO is at the option of the seller. So that is all from me. Thank you. Next, I will pass to the next presenter, Sarah.
Thank you, Fatiha. Now, I will present about derivative in Islamic bank. When we talk about Islamic financial, of course, we will be familiar with the criteria needed where all of the instrument used must following the Sharia compliant. As we know, all of the transaction involved must be free from the elements of unnecessary risk, interest, and gambling. If the contract contains one of the element, the contract will be voided. Other than that, Islamic derivative product must be in a form of tangible commodity because money cannot be treated as a commodity and they must apply the mechanism of risk sharing. In this case, we can see where the risk and the profit of the parties that involved in the financial transaction will be shared according to the pre-agreed ratio. There are several Islamic instruments where it has the same feature and thus can be used in derivative market, which are the instrument of salam, istisna, istijrar, and Islamic swap. For your information, some of these instruments are widely used in Islamic finance. First is salam contract. Salam contract is where we allow the goods or the asset to be delivered at the future date, but the price of the goods must be paid in full in the day where the contract is established. Basically, we can make a comparison between salam contract with the forward contract. The difference is where salam contract only one party defer his obligation, which is the seller, where he will only deliver the goods at the agreed date. There are 4 elements involved, which are the contracting parties, the subject matter, the price, and the akad. For example, we can see at the case of the broker and the buyer, where the buyer wants to buy a cocoa from the broker. Then they come into salam contract. In the contract, the broker will sell cocoa to the buyer. The buyer will pay for the price of the cocoa, let's say 100,000 in the same day. Then the broker will send the cocoa to buyer a year later. From this scenario, we can see that only the broker defer his obligation in deliver the cocoa on that day. Different thing happens in conventional, where in forward contracts, there are 2 elements will differ, which are the subject matter and the price. According to the scholar, if more than one element is differ, then it consists of the elements of gharar. Okay, the second instrument known as istisna. Istisna is a deferred sale contract where the price of the asset will be paid but in the form of stages in accordance with the stages of manufacturing of goods. With that, the manufacturer will manufacture the goods according to the specification needed. Okay, the Islamic institution will fund the manufacturer to construct the asset needed. The asset will be owned by Islamic financial institution. After that, the title will be passed to the developer who want to buy the assets. The difference between istisna and the salam contract, where istisna contract involve the asset that need to be manufactured and the good must follow the specification needed, while in salam contract, the asset is wider. In salam contract, the payment has to be made on that day and the delivery date must be fixed, while for istisna, the payment can be made in installment. When we enter into salam contract, we cannot terminate the contract, but for istisna, we can terminate the contract as long as the manufacturer does not begin their work yet. The third instrument is known as istijrar. Istijrar is where the buyer buy the assets with the seller on the ongoing basis from time to time. Istijrar have 2 types, which are the first type is where the price of the asset will be determined after the purchasing transaction is completed, and the second type is where the price of the asset had been determined in advance. During the financing period, the sale price of the asset is depend on the average of the market price, and the buyer and the seller have the option to fix the sale price. Either the price at the time is on upper level or lower level. Let's say a firm approaches an Islamic institution as they need a short-term financing on the duration of 6 months to purchase the raw material. Then the bank buy the specific material as needed on the behalf of the firm, then sell it to the firm. In this case, we can see then that the sale price of the material has not been set yet, as it will be determined at the end of the contract, which is 6 months as per agreed. The option will be used if the price fluctuates and exceeds the above or below predetermined level. During the financing period, the buyer has the option to fix the sale price if it is exceeding the upper bound of the market price. Also, the bank has the same option if the sale price fall below the market price. The fourth instrument is Islamic swap. There are two types of Islamic swap structure that are usually used, which are Islamic profit rate swap and Islamic cross-currency swap. IPRS is the agreement that involves two parties, which is the seller and the buyer, that make mutual exchange on the profit rate, which is the floating or fixed rate. For the ICCS, it used to be protect the currency by exchanging or swap the profit payment from one currency to another currency. The usual Islamic contract that have been used by Islamic banking in Islamic swap are tawaruk contract, murabahah contract, and wa'ad contract. To have better understanding, we can see the example how Islamic profit rate swap is carried out. In this case, it involves two stages, where the first stage is using the fixed rate. On the first step, by using the contract of murabahah Islamic interbank, bank sell asset to the customer with the price of cost plus profit, let's say 100 million plus the fixed rate of 4.2%, but the payment will be made later. On the second step, the customer want to sell back the asset to the bank at the cost price, which is 100 million. With that, the price of 100 million is considered settled, but the customer has to pay the bank the amount of fixed profit rate. We move to the second stages, which is the floating rate. The third step is where the bank sell the asset to the customer on the cost price, which is 100 million. After that, the customer sell back the asset to the bank, but using the floating rate, which is cost plus 3 months LIBOR. In this case, the bank need to pay the customer the floating rate, but at the same time, bank receive payment from the customer on the fixed rate basis. From this, if the amount of floating rate is larger than the amount of fixed rate, then the bank need to pay to the customer. But if the amount of floating rate is below the fixed rate, then the customer need to pay to the bank. We can see the example in Maybank where the bank use Islamic profit rate swap. There are two applicable Sharia structure, which are commodity murabahah structure and wa'ad structure. Okay, the commodity murabahah structure is where the buyer buy the Sharia commodity from the supplier, then sell with a markup price, which include a profit. Wa'ad structure, basically it is a promise. Wa'ad is a unilateral promise when one party make a promise to another party to perform something in the future, and it is a voluntarily offer. In Maybank, we can see when the party, they will provide unilateral undertaking by entering into multiple commodity murabahah transaction when they satisfy with the term and condition that agreed that specified in the wa'ad. For your information, in Maybank, the minimum amount for Islamic profit rate swap transaction is about 5 million, and the maximum amount is depending on the client. That's all from me, and I will pass to the next presenter.
Thank you, Sarah. So I will explain the advantage of derivatives. So as we know, derivative is one of the tools to mitigate risk in financial system. So the first advantage of it is hedging risk exposure. So what it means here is that the contracts are typically used for hedging risk because the value of the derivatives is tied to the value of the underlying asset. For example, an investor might buy a derivative contract whose value moves in the opposite direction of the value of an asset that he or she owns. Like profits from the derivative contract may be used to cover losses in the underlying asset. So Sharia compliant derivative also can maintain the risk sharing that favors situation from changes in asset value. For instance, the issuance of stock option to employees would be an ideal candidate for a Sharia compliant derivative. Why is that so? Because it is setting incentive for higher productivity. Firm owners reap larger corporate profits that offset the marginal cost of the greater employee participation in their stock price performance. So the next advantage of derivative is that it could also be said that the underlying asset price determination also one of the advantage of derivative. Why I am saying this is because derivatives are frequently used to determine the price of underlying asset. Like As we all know, derivatives are the contracts that provide you the right or duty to sell or buy a certain asset at a specific price at a specific future date. So the underlying asset, also known as derivative contract commodity, it is one of that will be bought or sold at a later period. For example, futures spot prices can be used to approximate the price of a commodity. So next advantage of derivative is that derivatives has its own market efficiency. So it is considered that derivatives increase the efficiency of financial market. So one can imitate the payout of assets by using derivative contract. As a result, the underlying assets and derivatives prices tend to be in a state of equilibrium. So as a result, when the price of the underlying asset rises, for example, someone can buying the call options because this is the smart alternative for the investors. So when you buy a call option, you get the right to buy an underlying future contract at the strike price or at any moment before the contract expires. So, for example, futures market prices rely on a continual flow of information from around the world and demand a high degree of openness. So, that's all the advantages of derivative. So I'll pass to the next presenter, Lingesh, to explain about the disadvantages of derivative.
Thank you, Shima. So now I'm going to explain the disadvantages of the conventional and the Islamic derivatives. The conventional Islamic derivatives are not only discussing the advantages and also there are several certain disadvantages could take into the consideration. In the light of the fact that several studies or cases shows that significant drawbacks especially comes from some financial instruments. Therefore, based on the global financial crisis on year between 2007 to 2008, stated that certain financial instruments such as mortgage-backed securities and also credit default swaps leads towards the collapse of financial institutions and securities all over the world. The disadvantages of conventional and Islamic derivatives such as higher risk, speculative features and also counterparty risk. First and foremost, higher risk. This is happen when the conventional and Islamic derivative speculative higher risk would be counted as when unstable idea of the derivative can prompt immense misfortunes. Besides that, the agreements are planned so that in terms out to be extremely neutral for the investor to value them. But in this way, there is a higher inalienable risk associated as well. For example, the forward contract is considered as a higher risk compared to the future contract. This is because of the contract is not standardized and unregulated. Another example that we can take into the consideration as well based on the Islamic perspective would be the Salam contract, which cannot be relied on and uniquely identify underlying. The next disadvantages of the conventional and Islamic derivative is speculative features. According to the conventional and Islamic derivative perspective, speculative features is considered as derivative an instrument which are regularly utilized by hypothesis operators in the market, where derivatives are amazingly unsafe and have unusual behavior. Any pre-Proteus theory utilizing a derivative would be those able to clear and help extensive segment of initial capital that has been made by the speculator. Based on the forward contract, future contract, option contract or swap type of contract can be varied in the form of speculative features. As an example of it, in the future contract, especially speculative traders rely on speculative futures, where they assume the market is headed. Despite of this, in a speculators imagine that a stock is overrated, where they maybe undercut the stock and trust that the cost will decay, so all those things considered intends to be repurchased for the profit. The next disadvantages would be the counterparty risk. So derivative agreements are exchanged on the trades where just as over as the counter. The agreements which are exchanged on the trade go through the due consensus measure where however the counter agreements does not have any benchmark for due steadiness, which means this forms a risk of a counterparty risk. Along these lines, credit default spot could be considered as one of the counterparty risks where the contract permits the investor to trade or balance their credit risk to another investor. For instance, if a lender is worried that a borrower is going to default on the loan, the lender could use the credit default risk to offset or to trade the risk who consents to repay the lender, in this case the borrower's defaults. Most credit swap contracts are kept up by means of ongoing premium payment, where like a standard charges due on the protection strategy, and this would not be benefit for the derivative instruments. In this case, these three types of disadvantages are really crucial in order to avoid uncertainty and in order to stabilize the derivative instrument. Thank you. Now I pass the floor to Ray.
Thank you, Linkesh. So we'll be moving on to needs of banks for derivatives. So initially, derivatives were used to protect farmers from incurring loss or unexpected tragedies. So, for example, if a farmer has 1,000 chicks and he would like to sell them once they have grown, but also he has the fear that the market price of the chickens will drop in the future. So the farmer gets into a derivative contract to lock a price that to be sold in the future. So averagely a chicken, it takes around 3 months to actually reach their maximum growth. So after 3 months, even if the price of the chicken drops, the farmer will still actually get the desired price, which was 3 months ago, so that he would not incur any loss. So derivatives are used to lock in prices in the future. It is also used as a leverage where it does not impact to get an upper hand in terms of financial, and then also to actually hedge against risk. So in this modernized era, banks often use derivatives to actually mitigate the risks such as commodity risk, stock market risk, interest rate risk, and also credit risk, or in other words, default risk. So these are 4 typical categories of risk that banks utilize derivatives to minimum their exposure to risk. So first of all, we are going to look into commodity risk, how commodity risk is hedged using derivatives. So commodity risk refers to the likelihood that price variation in commodities can result in financial losses for commodities purchaser or the producer. So the bank face the risk that commodity price will be higher than expected. So a bank that has to purchase the commodity in the future is exposed to the risk of a quick price increase. Therefore, a typical derivative known as futures contract can be utilized to reduce risk exposure to volatile commodity prices. Futures contract on commodities are exchanged on regulated exchanges. Commodities futures trading on regulated exchanges are probably goes back to 17th century where the Japanese rice market was. So the exchange determines the quantity and the quality of the physical commodity on which the both futures contract is based both then and now. Forward contract are also very much similar to the uh, futures contract. So secondly, moving on to stock market risk. So this is uh, a stock market risk is also known as a systematic risk as whole. So factors such as economic growth, recession, inflation, interest rate, currency exchange, and so on will actually give an impact to the entire market. So these factors are unexpected, but they will cause volatility and stock market risk. Common derivatives is stock equity options, which can be utilized to reduce exposure to risk of purchase or sell a stock at a specific price within a certain time frame. So for example, if I would like to we would like to purchase stock for a decent price. So let's say as a past experience, stock for AirAsia was bought. So when the AirAsia price was around 4 ringgit 10 cents, the stock was bought. So in order to reduce the risk of loss, uh, the put option was in order. So what does the put option means? So the put option allow their holders the right but not the responsibility to sell a certain quantity of an underlying securities at a certain price within a certain time frame for a small fee. So let's say we were to buy a stock. So a stock that is worth 4 ringgit 10 cent, and we do not want to incur any loss. So if we initiate the put option, we will have to actually pay a small price for it rather than incurring a lot of loss of for in terms of capital. So our capital will be retrieved, and we just have to incur minor loss, which is a fee for the put option. So once we initiate put option, when the price of the stock just falls more than the price of the capital that was invested, it the system will automatically sell the stocks for the bought price. So this is how derivatives actually help investors and bank in the stock market to reduce the stock market risk. So next, I would like to pass on to Ahmad to actually uh, explain further on the hedging of risk.
Thank you so much, Rick. Now, moving on, let's talk about the interest rate risks. Now, let's focus on the constraints, what people are facing of this risk. Now, the main theme of this problem is the fluctuation interest rate. Now, this happens when it comes to London Interbank Offered Interest Rate, or also known as LIBOR. Now, this kind of interest rate, this is where the interest rate is fluctuating. It can go higher and it could go lower. So when this inconsistency is happening over here, it would lead to inconsistent interest expenses payment. Now we are talking about an expenses that is being made every single month that is not even fixed. It could be different. It could be higher or it could be lower. Now that could create a lot of hassle for a company to manage their funding. Now, when this kind of thing happen, they are unable to budget their expenses properly and effectively. And chances are more potential loss could happen. Now, let me give you a clearer picture on how this happens. So imagine a company issues bonds to investor. Now, the company is issuing a flotation rate debt for the investor. So the risk that they are about to encounter here is that the interest rate could rise and then their debt becomes more expensive. So can you imagine the principal amount that they get from the investor, they need to pay full amount at the end of the period, along with the expenses payment every single month. So when the interest rate keep on rising and rising and rising, in the end, they would be paying a lot more than they initially agreed. So this could put the company into a lot of danger and a lot of risks. Now, what are the remedy for this kind of problem? So the remedy is swap contract. So when it comes to interest rate risk, swap contract is the common offset when it comes to reducing the risk of interest rate. So as mentioned previously, this is where two parties to exchange interest rate payment for a certain period of time. The reason behind this because they need to manage their exposure to rising or falling interest rates. So this is where the one parties agree to pay a fixed rate of interest rate to a trading counterparty. Now, what would they get out of this when they swap the contract? So in return, they would receive a flotation rate payment. It could be a gain or it could be a loss. How is that possible? So this is the further explanation. Now, let's focus here. Now, there are two companies over here, ABC and XYZ. Now, the principal amount that they are borrowing is $225,000 respectively. Now, the initial rate of ABC's company is LIBOR plus 1.3%. And for the XYZ is fixed rate of 5%. And then the yearly LIBOR rise is 0.75%. Now, remember, they are swapping the contract. So this is what would they look right now. So current rate of ABC is now fixed of 5%. And then the interest rate of XYZ, they are using the LIBOR plus 1.3%. Now, let's talk about how the process of this is going. Now, they are agreed to do it for 5 years right now. Now, let's focus on XYZ right now. The XYZ interest rate that they are paying to ABC. Now, they are paying $38,000, which is the interest rate being times with the principal amount. So it was a 3.8% for the first year. And then the interest rate paid by ABC is $50,000 for the whole 5 years because they are using the fixed 5% interest rate. Now over here, ABC's gain and XYZ's gain. So why is ABC's getting loss over here? Now focus over here. Now ABC is paying 50,000 ringgit of interest rate. However, for XYZ is getting a $38,000 of interest rate. Now remember what I said previously. They would get a flotation amount based on the swap contract that they just did. Now because of ABC is paying more, 50,000 ringgit, so they have excess of 12,000 ringgit. So ABC is gaining loss over here because initially if they hadn't swapped the contract, ABC would have gained 12,000 ringgit. But now ABC is getting lost and XYZ is getting a lot of profit. So it's a 1-0 for XYZ. Now, the same situation is happening for the second year. Now, let's take a look at the third year. If you notice, the interest rate for Libor is increased 5.3% because the yearly Libor rise is 0.75%. Now, when this happens, the interest rate of XYZ has changed, becomes a lot more, 53,000 ringgit. Now, ABC is paying consistently of 50,000 ringgit. Now, when this happens, ABC is now getting a gain, which is 3,000 ringgit of excess. So, however, for XYZ, they are getting losses, 3,000 ringgit. The same principle is applied. They would have got a different outcome if they hadn't swapped. So this is the thing that they are facing. So from the ABC side, they gain more than XYZ in the end, which is they get the surplus of 15,000 ringgit as planned. So for companies like XYZ that agreed to do the swap, they should put more consideration on managing their expectation on future variables and loss and gains. So they would need to evaluate, they would need to consider the things that might happen. How much would they gain? When would they gain? How much would they lose? When would they lose? So next, let's move on to the last risk, credit risk. Now, the problem with credit risk is, so the credit risk is essentially the market's perception of companies' probability of default. Now, every investor has this kind of nightmare and fear, which is they were afraid that the company would making losses and beginning and entering the phase of recession. So when this kind of thing happen, the investor would lose their investment. Imagine you are investing in a company and then the company is not doing well and then you lost all of your money. Now that is the biggest fear. So the biggest issue here is that the investors are fully dependent to the company's performance and operation. As I said previously, they are really hoping that the company is doing well, so they would get gain, and all of the investment would then be lost, just like that. Now, how to treat this? What are the remedies? Now, the remedy for this kind of risk is credit default swaps, or CDS for short. So CDS offers protection against a company default by allowing investors to take a position on the default risk of a corporate bond issuer. So right now, investors is playing a huge role in managing the default risk right now. So of course, the main purpose of this remedy is to reduce default risk. And then there are three parties involved in this, in the credit default swaps process: the CDS buyer, CDS seller, and the company, or also known as the bond issuer. So what is the process of it? Now, over here, CDS buyer. Now, CDS buyer, they would like to invest at the company. At the same time, they would like to provide credit to purchase a reference bond to add more fund to the company. So when they get more fund from the CDS buyer, the company will get a lot more cash flow in order to sustain and continue operates on their business in order to get a higher revenue and in order to sustain their business. Now, what CDS would get out of this? So the CDS will get an interest rate in payment from the company, bond issuer. So the concept still applies where the investor will get the return from the company out of interest rate. Now, if we only take a look at these two parties, it is not complete because the CDS buyer still bears the default risk. If the companies go bankrupt, the CDS buyer would go down with them. Now, this is where it gets interesting. So the default risk is actually being transferred to CDS seller. Now, the CDS seller would give a protection to the CDS buyer. Remember, we are talking about the CDS buyer giving a credit fund to the company to avoid default risk, and then if the risk is going higher. So the CDS seller plays a huge role in protecting and minimizing the default risk over here. Now, as I said, the CDS seller would provide the fund protection. So whenever the CDS buyer is facing loss because of the company, so the CDS seller would give a compensation or a fund protection for the CDS buyer. Now, what do CDS buyer get from out of this? So they will get payments from the CDS buyer to ensure the insured protection is served. Now, if you take a look properly, the concept is similar to the insurance process, which is exactly applies to the CDS process. Now, after all the effort has been put, after all the blood, sweat, and tears have been put in order to sustain the company, what happens if the bankruptcy still happens? What if default risk still happen? Now, the seller, which is the company or the bond issuer, the seller of the default protection is obligated to pay the CDS buyer the difference between the bond face value, which is the 1,000 ringgit par value. Now, after the default risk has happened, the bankruptcy has already happened. Now, if the bond is trading for 700 ringgit right now the seller of the default protection now is obligated to pay the protection owner 300 ringgit, which is the 1,000 ringgit par value minus the market price of 700. Now, the conclusion for all of this discussion, this presentation. So risks and uncertainties are inevitable when it comes to trading. So anything could go wrong. So recessions could happen, and then glitches, and then even losses could happen. But these kind of losses, these uncertainties are inevitable and it cannot be cured. However, it can be managed and minimized through bank derivatives. So as we discussed earlier, the types of conventional derivatives are swap contracts, future contracts, option contract, and forward contract. And then the types of Islamic derivatives are salam contract, istisna contract, istijra contract, and Islamic profit rate swap. And then we also discussed about the advantages of derivative banks, which is it mitigates the risk in financial system, the underlying asset price determination, and it increases the efficiency in financial market. However, the downside of the derivative bank is they have high risks and speculative features as well as the counterparty risks. And then the type of risks that they need to expect and they could encounter are market risk, commodity risks, interest risk, and credit risk. So, in a nutshell, businesses and investors could maximize their wealth and minimize the risk effectively with the help of bank derivatives. So that will be all from us. Thank you so much for watching.